So same-sex couples who have decided to tie the knot and get married, they have some tax considerations. The first of which is to select a filing status of either married filing jointly or married filing separately. For most people, married filing jointly is more advantageous because the amount of deductions you can claim are greater. But in certain circumstances, married filing separately may be more advantageous. To know which filing method provides you the least amount of tax, simply prepare your return both ways. Married couples are not allowed to use the head of household filing status. That is only available for individuals who meet the criteria in the Internal Revenue Code. So there are certain consequences associated with filing a joint tax return. First and foremost is that both couples are responsible jointly and severably for the amount of tax shown due on the return. What that means is if one of the individuals has an offset in place because of a child support arrearage or they owe money to a local government, their entire refund is subject to garnishment, even if a certain portion of it is associated with the withholding of the other spouse. Also, keep in mind that for 2015, the standard deduction available for individuals was $6,300 and for married filing jointly, $12,600. If you do select the married filing separately status, you would not be eligible to claim the earned income credit and other certain deductions such as student loan interest. If you are in a civil union and have not gotten married, under federal law, you are not eligible to use the married filing jointly or married filing separately filing status. You would file as single or head of household if you meet the eligibility requirements. Again, you would use the same filing status on your Illinois return as you use on your federal return. There is no deadline for getting married. Your filing status is determined as of December 31st. So as long as you were married on or before New Year's Eve, you are eligible to use the filing status of married filing separately or married filing jointly. Generally speaking, gifts to an individual in excess of the exclusion amount are subject to gift tax. For 2014 and 2015, the exclusion was $14,000. Gifts between spouses are not taxable. Also, couples making a joint gift are entitled to an exclusion of $28,000. If you haven't changed your name with the Social Security Administration and the name on your tax return does not match the name on your Social Security card, that could delay processing of your return. To avoid any delays, you may complete a change of name form at www.irs.gov. Acceptable forms of documentation are listed on your screen. The Homestead Exemption allows you to claim an annual exemption from property taxes that varies by county. The exemption applies to your primary residence, so if you own multiple residences, you only are allowed to claim the Homestead Exemption on the primary residence. Spouses who maintain separate residences may each claim the Homestead Exemption. One spouse should claim any dependents as an exemption on the return. That same spouse would be entitled to claim the educational expense credit and similar credits. The spouse with the larger income is usually chosen because deductions have a greater value at higher income brackets. The dependent must meet the test of either a qualifying child or a qualifying relative. And there are several tests, but generally speaking, they must reside with you, they must rely on you for more than 50% of their support, and they must not file their own joint return.